A few years ago, money was cheap, almost suspiciously cheap. Loans were everywhere. Credit cards, mortgages, startup funding, government debt. The price of borrowing was close to zero, and the system adapted to that world. Businesses learned to live on cheap money. Governments learned to roll over debt instead of paying it down. Markets learned to expect rescue. Then, inflation showed up, and central banks reached for the only lever they trust. Rates went up. On paper, that's supposed to slow things down for everyone. In reality, it splits the economy into two very different experiences. If you owe money, higher rates feel like gravity suddenly getting stronger. Monthly payments rise, refinancing disappears, risk becomes expensive overnight. A business that looked fine last year suddenly looks fragile. But if you own money, real liquid capital, the physics reverse. Interest rates are the price of money. When that price rises, money itself becomes more valuable. That's the first hidden winner. For years, savers were punished. Keeping cash meant losing purchasing power. Bank accounts paid almost nothing. Safe assets felt pointless. You were quietly pushed toward risk. Stocks, crypto, real estate, whether you liked it or not. When rates rise, that pressure eases. Cash starts earning again. Treasury bills, money market funds, short-term bonds, suddenly they pay real returns with almost no drama, no innovation, no hustle, just patience. It doesn't feel exciting, which is exactly why it works. But that's only the surface-level winner. The deeper shift happens inside the financial system itself. Banks love higher rates, not because they're greedy villains, but because of how their math works. Banks borrow short-term and lend long-term. When rates rise, the spread between what they pay and what they earn often widens. Every loan becomes more profitable. Every delay in paying depositors becomes a bonus. Meanwhile, the risk gets passed outward. If a loan goes bad, it's rarely the bank that feels it first. It's the borrower, then the investor, then the pension fund, then, eventually, the public. Higher rates don't remove risk, they concentrate it. And then there's the most misunderstood winner of all, governments. This one sounds wrong at first. Governments owe massive amounts of debt. Higher rates mean higher interest payments. That should hurt them. And in the short term, it does. But zoom out. Governments don't operate like households. They don't need to pay off debt in the same way. They roll it forward, they refinance, they tax, they inflate. When rates rise, governments gain something subtle but powerful: credibility. Higher rates signal seriousness, discipline, control. It reassures bond markets that inflation won't spiral forever. That trust keeps borrowing possible, even when debt levels are enormous. In other words, higher rates can stabilize the system just enough to keep it running. At the same time, inflation quietly reduces the real value of old debt. The money borrowed years ago is paid back with cheaper dollars. If wages and tax revenues rise alongside prices, the burden shrinks without a headline. It's not clean, it's not fair, but it works, often just well enough. Now let's talk about the losers everyone ignores. Not the obvious ones, not the over-leveraged traders or reckless speculators. The slow losers. Small businesses with thin margins, renters whose landlords pass costs upward, young professionals who did everything right but entered the market at the wrong time, anyone whose wealth depends on steady growth rather than accumulated capital. Higher rates reward what you already have, not what you're trying to build. They favor ownership over effort, liquidity over ambition, patience over speed. This is why rising rates quietly widen inequality. Not instantly, not dramatically, but steadily. People who have assets can wait. People who don't have them feel the clock. And markets know this. When rates go up, speculative bubbles deflate. Easy stories stop working. Cash flow suddenly matters again. Businesses that survived on promises struggle. Businesses that generate real income gain leverage. It feels like discipline returning. But discipline for whom? The irony is that higher rates are often sold as a moral correction, a return to responsibility, a punishment for excess. But the system itself was designed during decades of cheap money. You can't flip the rules overnight without consequences. Some players are positioned for this world, others never had a chance. And here's the part that should make you uncomfortable. Most people think rising interest rates are a temporary phase, a fix, a medicine that will be lowered once things normalize. But what if this is the new normal? A world where money has a real price again, where risk isn't hidden, where growth slows, where patience beats speed. In that world, the winners aren't louder, they're quieter. They don't chase returns, they collect them. They don't borrow aggressively, they wait. They don't panic when markets wobble, they're already being paid to sit still. So when interest rates go up, who actually wins? Not the people working harder, not the people taking more risk, not the people listening to motivational advice. The winners are the ones positioned to benefit from time itself. And that raises a final question worth sitting with. If the price of money keeps rising, what does that mean for a system built on everyone needing more of it tomorrow than they have today?